Good evening, everybody. Thank you for taking the time to join this session. Together with myself, I'm Wan Chen Loh, VP for SIAS, and we have here Kelvin Chow, CEO of Lendlease REIT. It's our pleasure to share with you the proposed acquisition of the remaining stake in GEM. And with that, let me hand over to Kelvin.
Thank you, Mr. Loh. Good evening, everyone. Thank you for taking time to join this section. It's our pleasure to share with you our proposed acquisition of the remaining stake in GEM, an integrated office and retail asset located in west of Singapore. The acquisition of GEM is a natural transition for us as we recognize its benefits and resiliency throughout the pandemic. The suburban retail market continues to perform well, and we believe that the Jurong region and its upcoming development plans will provide a great catchment for GEM. These are some key benefits of the acquisition, which we will go into the details in the subsequent slides. Post-acquisition, our portfolio size will increase 2.1 times to 3.6 billion. Net property income will also grow significantly to 147.8 million with a net property income yield of 4.2%. Weighted average lease expiry will increase to 8.9 years from 8.4 years. The concentrations of our top 10 tenants' distribution by gross revenue income will be reduced to less than 50%, and committed occupancy for the portfolio will be close to 100%. Post-acquisition, we will have a well-balanced portfolio with a Singapore-centric asset base of approximately 88%. Suburban retail sectors contribute to LREIT's portfolio will increase to 46.8%. Zooming into GEM, it is located in the heart of Jurong East and is one of the largest suburban malls in Singapore. GEM occupancy has remained consistently high at above 98% even after the onset of COVID-19 pandemic. Key retail tenants in GEM include IKEA, FairPrice, Cathay Cineplexes, and Don Don Donki. Its office component is fully leased to the Ministry of National Development for 30 years with a rent reversion of every 5 years. The agreed property price is 2.079 billion, a discount of approximately 0.3% to the highest of the two independent valuations, with a net property income yield of 4.4%. Let me share with you the key benefits of the proposed acquisitions. Based on first half FY 2022, the diagram on the right, the proposed acquisitions has an accretive DPU of 10.5% without rental rebates and expenses from COVID-19, or 6.8% DPU accretion with rental rebates and expenses from COVID-19. As we embrace ourselves to live with COVID, we believe the provision of rental rebates may no longer be required. Open communications and collaboration with our tenants will be the key focus. Moving forward, the inclusion of GEM into our portfolio will certainly add accretions to our portfolios. With the direct ownership of GEM under LREIT, it will attain tax transparency with a recurring tax savings of approximately 5.6 million per year. These savings will translate to distributable income to our unit holders. In addition, having full control of GEM will allow us to better manage operational matters and asset enhancements across our portfolios. As we have highlighted in the beginning, post-acquisition, we will have a well-balanced portfolio with a Singapore-centric asset base of approximately 88%. The resilient suburban retail sectors contribute to LREIT portfolio will increase to 46.8%. Our portfolio weighted average lease expiry will increase to 8.9 years. Unit holders will enjoy stable cash flow from GEM's office component, which is fully leased to the Ministry of National Development for 30 years. If you could bring your attention to the diagram on the right, essential trade services, which has been doing very well during the pandemic and will continue to perform well, will increase to 59% from 52%. The proposed acquisition will improve our portfolio diversification of trade sector mix, post-acquisition, government sectors, beauty and health, and supermarkets will account for approximately 23%. With the addition of high-quality tenants such as the Ministry of National Development, FairPrice, Dong Dong Donki, and Koufu, it will reduce the concentrations of gross revenue income contribute from our top 10 tenants to 41%. In the near term, we believe that GEM will be well positioned to capitalize on future trends as Jurong Gateway is to remain a strategic commercial location due to the development of the Jurong Lake District and the construction of the future Jurong Region MRT line and Jurong East Integrated Transport Hub. The Jurong Innovation District and the upcoming new Town Tengah will also complement the Jurong Lake District, increase the number of employment opportunities and homes in the West region. Lastly, how do we propose to fund the acquisition? The proposed acquisition is to be funded by issuance of consideration units, promissory notes, debt and equity fundraising, which may comprise a private placement and/or a preferential offerings. While this table shows you the total acquisition cost of the acquisition, funding requirement for the remaining 68.2% stake is approximately 1.79 billion, which comprises sponsor stake in consideration unit of 116 million, sponsor stake in preferential offerings of 118 million, net equity of 718 million, net debt of 821 million, acquisition fees in unit of 17 million. The commitment of our sponsor to invest approximately 234 million in the proposed acquisition is a strong alignment of his interest with the manager as well as the unit holders. Hope we have shared insightful information about the proposed acquisition. I shall hand the section back to Mr. Loh to proceed with the question and answer section.
Thank you very much, Kelvin, for that great
you.
presentation. Before we go into some of the details, let me sort of preempt this with a number, the 10.5% accretion in DPU before rental rebates, and after that, if the rental rebates and COVID expenses is 6.8%.
Yeah.
So those are eye-watering numbers. These are amazing numbers. So keep that in mind, Kelvin. We'll go to that as a second question.
Right.
But first question, with the acquisition of GEM, you're going to have a big exposure to Heartland Mall.
Yes.
GEM is not a small mall. It's as big as, in terms of footfall, compared to 313.
Yes.
So it's an amazing mall. So
Thanks.
does this change the profile of Lendlease REIT?
Yeah, I think it's a good question, and it certainly will change the profile of the Lendlease REIT. I think there's from a few dimensions, of course. I think first of all, it will increase our Singapore asset base from 76.5% to 88%. I think that will certainly means that we have a stronger commitment in Singapore. And we believe that Singapore will continue to be a well-regarded kind of business environment for a lot of business. At the same time, I think the mall is continue to be very relevant. And also given that the location of GEM is actually very ideal. And perhaps I share with you a few key observations that we have. I think, first of all, GEM is located at the heart of Jurong East.
Yep.
And basically, it's very well connected with the transportation lines, like the MRT, bus interchange, and also offices and the nearby amenities. I think the other thing is that it has a very strong catchment. I think it has around 1.1 million kind of catchment around the area, which probably make up close to 20% of the Singapore population. I think that's one plus point that we think it actually makes sense for us to actually consider this asset. I think the third point, I would say that it actually the average the household income in that region is actually around 5% higher than the national household income from the observation that we have from 2015 to 2022. So that again gives it a very good value proposition for us to consider this asset to be put into the REIT, and how it will change then the profile of our portfolios. I think the last thing, which is a very important thing, is that as we were to consider acquiring now, actually we are sort of at the start of, or rather at a good timing that we can actually take advantage of all the surrounding development around the Jurong areas. I think few of the development that you were of course aware of is the perennial business city that is developing next to it, and also the Jurong Lake district development. I think somewhere slightly further will be this Jurong Innovation District, which all these will certainly create massive footfall and also higher sales number to the mall performance itself. And it will add a lot of job opportunities for the surrounding areas. Likewise, homes, which I think the Tengah, the Forest Town, is going to build around 42,000 kind of new homes to the area. All this will means that if we position ourselves there, we will be able to have all the upside potential from all this development around the areas.
And with that exciting development in the hub, is this the right timing, Kevin?
I would say certainly it's the right timing, and let me maybe help define in several ways. First of all, from the global perspective, you will probably feel and you know that I think most of the countries have already slowly move out of these pandemics and change it to an endemic approach to COVID. So a lot of countries have been opened up for travelings and all those things. I think for example, Australia has been allowed people to travel as long as you're all vaccinated. I think even in the light of Vietnam and Japan, they also allowed people to travel already. And more of this means that people will be, that means that the activities, business activities and all those will
be
uptake, yes. At the same time, I think Singapore is also trying to open up more of this VTL to allow people to travel. And also I think the recent announcement of easing the restrictions for the 1 meter kind of social distancing has also been a way that I think government is trying to move to an endemic kind of approach to the COVID situation. So all these are good for the mall because you will start to see people going back to more freely. At the same time, people start to live with COVID. I think that is the first thing. I think secondly is what I talk about, the location. I think the location is certainly, I will not mention again, those few points is something that I have described. I think the third thing is really the performance metrics of GEM is very strong. I think in my presentation, I did actually share that the committed occupancy is around 100% actually for this latest quarter. And for the past, since FY19 to now, has been always maintained above 98%. I think secondly is the trade mix. The trade mix that we have actually also been strengthened in a way we bring in a new kind of tenant like the Ministry of National Development, and also we bring in the beauty and health and also supermarket. These make up around 23% of our new trade mix compared to previously. We don't have a few of the government and the supermarket. We don't have it. I think that will certainly improve our resiliency of the trade mix and also more diversified in a way so to balance up on the portfolio. I think The third thing is that the essential trade services actually has also been increased to 59%. So as we been through the whole COVID, we know that essential services has been always very resilient. Even during the COVID, I think people will still need to go and buy the basic necessities and all those things. And having a mall that able to have a strong kind of rather very high proportion of that essential services certainly give a very good stability on the cash flow and resiliency of the cash flow. I think the other 2 points that I might also want to share with you is that in our leases, and most of our leases to the tenants, we have this inbuilt annual escalations, which I think the tenant will certainly be able to enjoy that kind of rental escalation. Even without doing anything, it have that kind of natural escalation. And of course, I would like to show you that for 313 is about 3%, and I would say GEM is about the same. I think this is something that the investors or the unit holders can actually expect that kind of growth
3%
on the rental revenue itself, 3%. I think the last point which I want to emphasize is that our mall sales has already above exceeding pre-COVID.
Oh, that's excellent.
Yeah, and that kind of metrics means that we can certainly be able to move our rental higher moving forward. And if you were to buy now, unit holder will be enjoy the upside of that kind of rental pickup. And I think if you look at other REITs that have the suburban mall, you will notice that they have already started to reporting positive rental reversion. So we don't want the unit holder to miss the opportunities. So buying now, I would say, is the right time to do so. And also buying now could mean that we are buying the asset at a COVID valuations. And then you will certainly have some pickup of the valuation also. Yeah.
One more question, Kelvin, before we go to the magic numbers.
Sure.
10.5% and 6.8%.
Yeah.
I mean, once again, those are amazing numbers.
Yeah.
But one question, can we afford not to do it right now? If a unit holder say, Kelvin, don't buy, what's the implication of not doing anything?
I think it's a good question. The implication is just that we will miss the opportunities. And it also means that we will miss the growth perspective of the asset. And I believe this asset will certainly have a very good yield pickup.
And there are not many of these kind of golden opportunities.
Yeah, right. I think you're totally right. And there's not a lot of this type of golden opportunities. To be honest, I wouldn't think that in the near future, or rather probably a few years down the road, you can see such a trophy asset that is put in the REIT. And Lendlease being able to manage the asset and able to convince the other fund investors to divest their stake to put the asset into REIT, I think is really kudos for us to actually do that. Yeah, it's not easy to do that actually.
And I like the word that you use, Kelvin, as a trophy asset. Plus 313. 313 is a great asset.
Thank you.
You have another one in GEM. I think that's a great combination.
Thank you, sir.
So let's go to the magic number.
Magic number.
10.5%.
Right.
How did we get to that number, Kelvin?
Okay, I think what we do is that if I may actually show the slides. Yeah. Yeah. Basically, I think the magic number comes from this slide. And it actually based on the two shaded column, basically the column B and the column D. So what we are looking at is that we are able to move the performance of the current portfolio, which is holding just the 313 and Sky, which is on column D, which is a DPU of 2.55 cents to 2.49 cents. And that is simply by the pure performance of the asset itself, and based on this current COVID performance. And I believe that the asset can perform very well. So I think the question you might ask is that why column B and not column A? Column A basically is the result that we have announced recently on our first half of FY22. And that column, the DPU is 2.4 cents. And 2.4 cents is also consists of our existing stake in GEM of 31.8%. But But the 31.8% investment actually is in NAV, and that it means that we actually invest in net of the debt portion in the asset. So in that case, the performance is higher. So it might not be appropriate for us to compare that to the column B, because column B is totally a pure 313 and Sky performance, which is our current portfolios. So with that, we move to column C, which is from 2.55 to 2.40. That's when you can really see the upside of with 0 to 100%, what is the pickup of the DPU. So of course, column D might not really give you the true performance of GEM, because column C do actually have some kind of COVID impact to the number itself. And this is due to the 2 weeks mandated closures by the government that we need to close the mall for thorough cleaning. So for that, we actually close for 2 weeks. But in actual case, if you take COVID as an endemic, I don't think such thing will happen again. So we always ask people to focus on column D, which then actually strip off the impact totally. So if you compare column B to column D, you have this magic word of 10.5% increase. But some people will not be convinced. So you said, but in actual fact, you own 31.8% already. Why you actually want me to show me from 0 to 100? Okay, I mean, fair enough. If that's the case, we compare column A to column D, which will also give you a very decent kind of yield accretion of around 3.6%. And I would say that 3.6% is a very good yield. I mean, given that this is a Singapore asset, you are not looking at any kind of foreign currency risk, any kind of uncertainties,
political risk,
and you are able to know the performance of the asset very well, because we live with the asset in Singapore. We know what is happening to the asset. Yeah.
Okay. One more question, Kevin, before we go over to funding.
Yes.
And participants, please remember to submit your questions to the chat box. You have any questions for Kelvin in regards to the acquisition of GEM? So 10.5%, Kevin, can I ask you, how confident are you?
I think it's a good question. And to be honest, the number that we show in the slide just now is a true performance, is the actual performance of the GEM, which without any kind of rental support and all those things that actually beef up the numbers.
And you're already there already.
It's already there. And to be honest, this is the number that is during COVID. And I believe the asset can perform even better. And
now your sales are already ahead of pre-COVID.
Ahead of pre-COVID, but the rental might not be ahead of pre-COVID.
Fair enough.
Yeah, that's one of the things. I think I might also want to share with you a few more levers that we think can also improve on the return. And one of it is what we have announced of our sustainability loans that we have announced yesterday. We are able to work on this sustainability loan. And basically, what it means is that as long as we achieve certain kind of sustainability targets, it will going to reduce our cost of borrowing. And that is not factored into the numbers, and definitely it will be a good yield pickup for the numbers. I think the other things that I might not actually have shared is that our tax transparency treatment. As the performance of the asset improve, likewise, you will have a higher tax saving because of the tax transparency arrangement. And again, that is not reflected in the number. I think that is something that you can improve. And also, we have identified several pockets of space, which this space yet is, again, is not reflected in the number, and it will certainly be able to improve not only the distribution, but also the valuation of the asset. Upside. Yeah. So so
when you recycle GEM,
you will get that upside. And even if you are not recycling GEM, that cash flow is additional to what we have actually presented to you in the circular, which I would say that it will probably more than 10.5%. Yeah.
That's amazing. So you have a trophy asset. If the transaction goes through, you have 10.5%. That's amazing.
Yeah.
So now the third leg, funding.
Yes.
It looks a bit complicated, Kelvin. Private placement and preferential. So maybe Kelvin, to explain to our unit holders out there as to how this formula came about.
Yeah, I think it's a good question. For us, it's not going to be very complicated transaction. We just want to actually hit the market, do the best. We structure the best funding structure to the best interest of the investors. And for us, I think we look at issuing placement. We look at issuing preferential shares to actually cover our equity fundraising portion. Whereas for the debt, we managed, as I shared with you earlier, we managed to get a sustainability loan. Then that's where we cover the debt portion. It's about 50% on the required cash funding for that structure. And also the sponsor actually committed to take up their pro rata share on the preferential issuance.
234 million.
In total, 234, because they also hold a small stake in GEM. When they divest, they never cash out. They actually reinvest in terms of units to the REIT to show their strong belief in the asset and also the performance of the REIT. So they reinvest the money into that. I mean, they can easily cash out and do something else, but I think their interest is aligned. They want us to perform. And perhaps I might not have shared with most of you all is that this will be the one and only REIT in the Lendlease Group. And Lendlease Group do focusing on commercial asset. And Lendlease Group do have a lot of commercial asset in the pipelines and also in the fund they manage and also probably in some kind of development asset properties that they have. So we will be the happy recipient to those assets, certainly. Yeah.
What can go, what's the downside for unit holders with this kind of funding? Is there any dilution of their interest, any impact on them?
Yeah, good question. Actually, what we're looking at is that, of course, we want to bring the best asset to the investors and the unit holders, and also we want to let the unit holder enjoy the upside of the asset as the asset slowly pick up its performance and also a lot of different levers that we say that we can unlock values from the asset. So I think the only things that will probably dilute the unit holder's position is that you don't participate in the preferential issuance, which I think what we want is to have the unit holders to participate because we want to reward the unit holders of their commitment to us being our good unit holders to continue to enjoy the upside. And we have a very strong belief in the asset and we feel that this asset will certainly bring the upside to the unit holders. So we want the unit holder to enjoy the upside. So that's why we want to use as a preferential issuance to the unit holders. And if they pick up, I think certainly there's no dilution, but it's only a positive upside to the unit holders.
There's one question on renounceable rights issue for unit holders. Is that an option?
I think it's a good question. I think renounceable right issues certainly has its up and downside. I think the downside of it is that it certainly means that you need a longer time to sort of do the whole fundraising exercise. Yep. I think the other thing is that you also have to provide easily around 25 to 30% discount to TERP, which will certainly bring your NAV to below our current NAV numbers. And I would say that it will be a very big dilutions to our NAV and also DPU distribution. That again, if let's say unit holder didn't pick up, it will mean even a bigger kind of loss to them because they will naturally have to the NAV has dropped because of the big discount and they have to it will take time for us to actually recover from that kind of discount. So I think the best way to contain that kind of dilutions is really to do as what we are doing is the preferential distribution because it doesn't require that kind of big discount, but at the same time, it do actually reward our unit holder with a very positive kind of asset performance from our enhanced portfolio if they support our proposed acquisitions.
Okay, Kevin. So in summary, so far, unit holders, participants, we got in front of us a great trophy asset described by Kelvin. Great numbers, 10.5%. Good confidence in getting the numbers.
Yes.
Maybe 6.8%. If
If they want to compare with the current holdings to 100%, yeah, it's about 3.6, but also 6.8. I think is also something that you can look for at the distribution.
Yeah, but all in all, good numbers.
Yeah.
And funding is taken care of.
Yeah.
And sustainability is a hot topic now. And the fact that you're in sustainability gives you that edge in terms of cost of funding.
Yeah.
So
and reduce the cost also.
So to wrap it all, it sounds too good to be true. What can go wrong? I don't want to be a pessimist, but what can go wrong?
I think what will go wrong if, let's say, unit holders didn't support the acquisitions, which I hope that unit holder should support the acquisition because of all the positive element that I have described to you, and also it's a very strong asset. To be honest, as I share with you, I say it's a trophy asset. It's really a rare deal you can find.
Once in a blue moon.
Once in a blue moon, and no one will actually, if they have this asset, they will not put into the market. They will rather hold it and probably pass it to maybe of the other subsidiaries.
Myself, if you 3% rental going up every year in the good hub.
Yes, agreed. And also the latest recent comparable transaction is only generating around 4% kind of yield, but this asset itself generated 4.4% during COVID period. And we believe that it can actually even do better than that.
And now post-COVID, it's not post-COVID, we're still in COVID, but compared to pre-COVID, the numbers are looking good.
It's looking good. Yeah, we are very positive about that because we have been managing the numbers very well, like monitoring the numbers very, very closely.
Okay, that's great, Kevin. I'll give you some time to have a drink while we get some questions from the floor through the chat room.
Yeah.
So there's some questions from pre-submitted by unit holders. NPI for GEM post-acquisition, impact on NAV before and after acquisition, very numbers driven. So unit holders seem to want to deep dive into the specifics. Maybe Kelvin, you want to answer a couple of these questions before we get questions from the floor?
I think it's a good question. Okay, what happened is that as I have shared with you, we do actually have many levers to sort of improve on the NPI. So our plan is to actually execute those levers that I've talked about. I mean, as apparently you already see that we have already actually executed one of the levers, which is the loan. We already sort of engaged ourselves to a sustainability loan. So as long as this deal is passed through the EGM, I think we were able to sort of bring in the loan. And that loan itself certainly has the kind of saving on interest as we achieve the sustainability target that is spelled out in the loan. And the saving is actually quite huge in a way because we are talking about a very sizable loan. So I think that's one. And also I told you about this, our current mall sales actually has been quite high. We already moved out of pre-COVID and in fact achieved something of perhaps not to be definite, but we achieved something higher than the pre-COVID.
Footfall has been great.
Footfall has been certainly great also. I mean, everyone, even the weekday, they were telling me that, oh, it's been so busy. Yeah. And if everyone were to actually go to the mall, you will know that the marché in GEM actually has to be, you have to give your order just like a normal restaurant. Whereas you go to the marché of maybe other location, you can actually go to the store and then order your food, and then they do maybe scan your card, and then you can then go around. They have an even different store concept, but we don't have the space. They don't have the space for that kind of concept. That one requires a big space. When you set up store around the road and around the pathway, people will just go and order their food as they like. But I think they cannot afford that. That's why they really have a very strong occupancy and all those things. So I believe that means that the mall were able to have a good pickup as we walk out of COVID, and as the market certainty is stronger in terms of the trajectories of moving out of the COVID. Of course, the surrounding development, as I have also shared earlier, do actually give a very good kind of future growth into the mall in terms of footfall and also in terms of sales. That is something that we will benefit from that growth. Likewise, I think I talked about the 3% or several 3% kind of annual escalations that we inbuilt on the lease. That's something that we have, and that will certainly improve the NPI than what we have on the current level. I think the last thing, of course, I have already shared with you all the additional space that we have identified in GEM. That has not been reflected in the number, and that itself, if we were to unlock it, it will certainly improve on the NPI. Likewise, also improve on the valuations, because any kind of this will improve on the cash flow method on calculating the returns of the mall, and then it will improve on the valuations. I think these are all the visible levers that we can use to sort of unlock values and improve on the distribution. And if you say 10.5% is great, I tell you, you could probably see more than that.
Okay.
Yeah.
That's amazing, Kelvin.
Yeah.
A couple more questions. There's a question on the REIT buying direct from the sponsor. Would the manager not charge such a high fee for the acquisition?
Yeah, I think it's a good question, and I think that will certainly be a question that is being asked for all the IPT transactions. But to be honest, we are just being classified this as an IPT transaction because it's based on definitions from XGX and MAS. And the actual fact is that Lendlease doesn't own the whole asset. Lendlease only own effective 9.8% of the whole the balance stake itself. So to be honest, what we are doing, or rather how we actually go through this transaction, is as good as we're going through with a third party. We need to do like the legal duty, technical duty, it's all arm's length kind of arrangements. So we actually go through a lot of evaluation and assessment. So I think it's only fair that we actually take up the acquisition fee as we are really performing as good as a third party kind of acquisition. And also our sponsor is listed in Australia. I think there will be certainly I mean, they have to justify why is it that they will have to have a discount or maybe reduce that kind of acquisition fee. But all in all, I believe what we put on the table is certainly a good deal that unit holder won't regret of taking it up and wouldn't regret of supporting us. So hopefully that gives you all a good confidence that while we actually put while we do actually charge what has been spelled out in the IPO prospectus in terms of acquisition fee, we do also bring a good asset on the table for you to consider, and also a strong resilient cash flow that you can enjoy after the acquisitions. Okay.
There's a pre-submitted question on funding structure. I think we spoke about a lot about funding structure already.
Yeah, spoke about.
So let's not go into that.
Yep.
But what I'd like to talk about, Kelvin, if you can, sustainability. Now your cost of funding has gone down. This discounted because if you meet the sustainability targets, you get better cost of funding. Maybe you can share with us a little bit about your sustainability strategy, what you're doing, because it's such a hot topic now, and exchange is requiring climate change report. How does that affect the valuation of the organization?
I think for us, sustainability is certainly is in our DNA, be it in our parents or be it us as a subsidiaries in Asia. So we always very strong. We are looking at in the near terms to be net carbon neutral by 2025, and probably
that's only 3 more years from now.
Yeah, and actually gross by 2035, if I'm wrong. Yeah, so we do actually have a roadmap to help to sort of pace us up to achieve that target, not only on the REIT perspective, but really on the group perspective. So we are very serious about achieving that target. So to us, that's why even if we set up the sustainability loan, we don't feel that it's something that we feel difficult to achieve, because it's actually what we are going to walk through anyway. Yeah, I think the other thing is that the asset itself is also a very good, has a very strong sustainability credential. It's actually second in the GRESB award for the past few years in its category, and also they have this Green Mark Platinum certificate, and is I think first of this BCA kind of green certificates and all those things. It's very green. So if we put into our asset, put in our portfolio, it certainly enhance our portfolios in terms of the sustainability perspective.
Okay, that's great. Sustainability is such a game changer.
Yes, yes, and we always, or rather, I always want to support the sustainability initiative because I believe what we're doing will affect the futures. So if you are not going to change how we're going to do things, I think you will destroy the future of the next generation and all those things. So we should start doing it now.
Long-term value creation.
Exactly, true. And in fact, I have just having a lunch with one of the local banks. I'm also actually looking for other kind of sustainabilities, kind of borrowing or even deposit to actually sort of enhance our sustainability credentials. And that is something that we always want to have been a lookout to see how we can further improve our position in sustainabilities.
Certainly, there'll be a lot of opportunities with Singapore Exchange now requiring climate
Yes.
reporting.
We are going to do that also.
Oh.
Yes.
Anything to share with participants on climate reporting?
I think what we do is that we will actually enhance our reporting to make sure that we embark on. I think the latest is the
TCFD.
TCFD,
the Task Force of Climate-Related Financial Disclosure.
Yes, and we will certainly cover that and on our annual reporting. At the same time, we will likely be adopting it earlier and all those things to make sure that we report something to the standards. And of course, the TCFD thing is also to sort of streamline and the standard across different kind of measures, which I think is good, so that in that case everyone have a common understanding to that, in order for them to report, and also the readers that read the reports will also have a good understanding, because it will not have different kind of metrics, and some might be underweight on certain criteria and overweight on the others. So it's a good approach that I think we should support it, so that to benefit the unit holders and readers when they actually try to interpret on the reports itself.
I'm really impressed, Kelvin. There are not many CEOs who can talk about TCFD. And for unit holders who are not familiar with TCFD, it's about doing good to do well.
Yes.
If you do good, you will do well, and you get more than 10.5%.
Thank you. I believe so.
Okay. Yes. Let's go back to a little more back to the nitty-gritty details. There's a question from the floor on gearing ratio post-acquisition. Any thoughts on that?
Okay, the gearing ratio will be around 40.7%, and the interest coverage post-acquisition will be around 4 times. And also, would like to share with you that there are a lot of ways for us to sort of manage the gearing ratio. Although the MAS ruling is actually on 50%, but for us, a long-term plan is to actually bring it down to 40. Although now we are slightly above 40, but we do actually have ways to actually bring it down. All those levers that I mentioned to you, if you were to capitalize it, certainly it will give you the kind of ability to bring it down, because valuation improve. Yep. And then you will bring up the NAV, and then likewise reduce the gearing. Mm-hmm. I think the other things that we are also trying to highlight is that the current price, the valuation that we are acquiring, is certainly a kind of COVID valuations, because when we look when we do our valuations, I think we do actually understand that some of the valuers do put in a longer kind of duration for fit out because of COVID, because of shortage of labor, because of shortage of materials. So the fit out period is longer, and also they do actually put in some kind of lower rental for reversion and all those things. But as we look at it on the mall performance, the mall already exceeding what they have on the pre-COVID in terms of mall sales. Mm. So that will means that it probably is a bit conservative for the valuers to actually take that position. But it's good, but it kept the upside for us, and then that will be able to help us to actually improve the valuation, likewise reduce the gearing. I think valuation is one of the methods that we believe we can do so, not only on GEM itself, but probably our asset that we have in like 313 and also Sky in Milan. I think there are ways, as long as we improve the cash flow, the valuation will certainly be also improved. I think we are also having several kind of we are also looking at several kind of capital management approach to sort of improve on the gearing, which of course, I mean, that is more strategic. I might not want to go into the details, but certainly we have ways to bring it down. And now, just to let the unit holders know, 40.7, although it's slightly above 40, but our long-term commitment is to bring it down to 40.
That's a good number. Gearing ratio of 40.
Yes, so that we have a very good buffer between 40 to the government limit of 50.
Yep.
And we look at that easily, that will equate to around 0.6 to 0.7 billion of kind of pathway for us to reach 50. So while we do actually have a very decent buffer, but I think we believe that if we bring it lower, I think unit holder will appreciate that kind of effort.
More breathing room.
Yeah, more breathing room. That's right.
Okay. There's one more question on another trophy asset, potentially another trophy asset, Parkway Parade, before we go into the Q&A from the floor.
Yes.
So is Parkway Parade in the pipeline, Kevin?
Okay. I think all asset that is available or managed by Lendlease, I think we will certainly consider. But of course, we also lay out few criteria in our IPO prospectus. I think one of it is that we certainly have to make sure that the asset is 80% leased out. So in that case, we want to actually bring in an asset with a healthy cash flow for our distribution. If it's below 80, I don't think it gives a very good kind of distribution metrics. Secondly, the asset shouldn't have a lot of AI enhancement for the next 2 years. So in that case, if let's say, for example, now Parkway, there's a lot of construction around the area.
Because of the
yes,
train line.
And then they might want to build another path to link the train line, all those things.
Yep.
That's how AI works. So we don't want to acquire the asset at the same time, raise money again from the unit holders to support the AI kind of things. I think that is not sensible. It's not sensible to do that. So there's something. I think the third thing is that it has to be on the market rate. That means we don't want the asset to be under rent. So that in that case, we really are looking at the market rent when we acquire the asset. And the fourth point that we are trying to focus in is that when we acquire the asset, it has to be the market condition is really conducive, is something that is receptive to the investors. So if let's say the investor like the asset, then we could consider that. Of course, you rightly pointed out, it actually has been there for a while.
A long time.
So you have to see how well they do through this current AI. If they say they manage to actually make it a good asset, and then the cash flow has been quite stable and kind of thing, we could consider. But I think all depend on when it's available.
An opportunity.
Opportunities come by.
Okay, thank you.
Thank you.
Thank you again.
Yeah.
There's a question from Mr. Matthew Fu on the value creation. Maybe Kelvin and see whether you can address this question.
Okay, the manager will direct. Yeah, I think these are a few points that I shared with you earlier. Of course, I might not share with you all the points because I might not remember all, but as what I shared with you earlier is that, I mean, like for example, the loans, because it's a sizable loan and we achieved that kind of sustainability target, we will get to unlock some good values to the unit holders for distribution. Likewise, we continue to push the performance of the asset, and then that performance of the asset will through the tax transparency system, we will also unlock more values to the investors. I think the space that we talk about, the annual escalation, we talk about it, and also we talk about the higher kind of sales number, which then we will then bring our rental reversion higher for sure. Yeah, I think that is something that we will certainly be able to enhance. I think hopefully that answer to the question. If not, we are happy to sort of beef up.
Thanks, Kevin. There's another question on DPU. Technical question. So would you like to bring up the table again?
Yeah, good question. Yeah, I think it's a very good relevant question. Yeah. Do you mind?
Maybe you can bring up the table? Because I guess people look at the number and say, wow.
Yes. And too many columns to sort of dissect.
Yeah.
I can understand that. Yeah, I think this audience really point out a good point. Okay, what happened is that on column A, the DPU is actually 2.4 cents, but it's actually heavily geared. One thing, that means we actually finance this acquisition of 31.8% with a very high kind of gearing. That's why then the cost of debt will certainly be lower, which means it might not be a comparable comparison. And secondly, we actually invest this 31.8% on NAV values. That means in a fund, and this fund is also geared. So in that case, likewise, it improves the performance of our investment. So that's why the column on A, which is a 2.4 cents, is not really comparable to the column in C of 2.4 cents, because column A, the 2.4 cents, is first of all heavily geared. Secondly, the investment sum is lower for the 31.8%. So if you normalize it, I think first of all the return will be lower, and then you will see really a true uplift from the 31.8% to the 100% between column A to column C. So remember, it's the two things that make the difference. One is that our investment of 31.8% is heavily geared, and you remember we don't have any fundraising. We only do a perps and also a debt to acquire it. So the cost of funding is lower. But when we move to 100% on column C, right, column D, we actually bring down the gearing all the way to 40.7. So in that case, that's how you should look at it. And also, we invest not the asset, the 31.8% based on the asset value. We invest on the NAV value. NAV value is lower because the NAV do actually include also some debt element to it, which easily be probably 50% or more on the fund level.
Okay, another hot following question on DPU, Kelvin.
Yeah, the portfolio financial effect. The DPU based on the enlarged. Yes, the DPU is based on the enlarged number of shares. You're right. Yeah.
Okay. Let's see whether there's any more questions from the floor.
Any plan for future acquisition?
So somebody's asking you, Mr. Yao Bok Guan.
Yeah, Mr.
He's asking whether you got any more trophy assets out there, any more Blue Moon.
Blue Moon. Thanks for the question, actually, Mr. Yao. Well, what happened is that, of course, we do. Everyone also perhaps know that we are managing this Paya Lebar quarter. PLQ, yes, is a huge asset, of course.
Nice asset.
It's a nice but huge asset. So it's pretty young. Probably it's only operate for like 2 to 3 years. So it's a very new asset. By the way, GEM is also a very new asset. So in the case, we put in a new asset so that in the case, you can generate a good continuous kind of return.
GEM is about what, 9?
It left 88 years. So probably it only have like 11 years past. Yeah, so it's a very good asset. Likewise, it's 3 on 3. So all the assets that we have in the portfolio, by the way, is very new, very young. So I think that's one. Of course, PLQ is one of the considerations that we might want to put into the portfolio. But of course, first of all, it's relatively young, so we have to look at the cash flow, whether it makes sense for us to actually participate. And also, the size of the asset is very huge. But fortunately, when they construct and also construct the development, they actually break that development to 6 strata titles. So the mall is 1 strata title. The 2 office building each that just next to the mall has 2 strata title each one. And then across the road, there's another office which actually has 3 strata titles. So we might not be able to acquire the asset as a whole, but we could actually consider acquiring the asset probably by strata titles as it is, as long as it meets all our criteria in terms of accretions and all those things, good distribution, EI, there's no EI and all those things. So I think that one we can consider. Of course, we can also consider maybe buying a stake in the existing fund which enjoy the cash flow from the 3 office building and the mall. So we have yet to consider that, but that is certainly something we can think about it after we acquire the GEM acquisition, which I think our focus is really on GEM now. And I think that is for the near term, because we want to continue to be very strong present in Singapore. We believe investors like us to be exposed more in Singapore. I remember when we go through the EGM to acquire the 31.8%, we achieved a support of around 99.91%
Wow.
on the EGM. And I think that is a good signal that the investors really like the asset very
So
much.
right asset.
Yeah, so it's the right asset. So that's why it gives us the courage or confidence to actually go ahead and talk to the current fund investors and to propose to them on the acquisition of the balance of 68%. So I think that's what we are looking for. So we really want to achieve that kind of this milestone to achieve the balance to make ourselves 100% on GEM, because having a full control of GEM will help us to execute some of our plan better, managing the asset better, and also unlock value better comparative to holding a partial stake. But in that case, hopefully I answered the question, is that our near term is really see how we can sort of look at asset in Singapore. I think PLQ is one of the obvious victim, obvious target. And of course, we will look at also asset probably in our parents' location. Our parent is listed in Australia, by the way. So you might actually consider some of these possible asset, because our parents certainly is well connected. They have a lot of development. It could also be having a lot of exclusive deals in the market. I mean, some of the REIT actually acquired our asset from our sponsor.
Yep.
So directly. So there are always opportunities from us from Australia, because our parents is very prominent in Australia. And you could also consider asset probably in Europe, given that we do actually have an asset in Milan, which we are very familiar with the structure. And we're also familiar with the economic there, and also understand how to actually structure the deal so that we have the minimum or rather zero kind of tax exposure. To be honest, I think, or rather not a lot of unit holder might actually know us, is that our Milan asset, when the cash flow transfer back to Singapore, actually has zero kind of withholding tax. I think that is something for us to actually improve the returns of the investor. So we want to structure it in a plain vanilla, but in a good way, that when we repatriate the money back, there's no additional tax suffer, and good enough that we actually manage to structure it with the zero kind of tax exposure. Yeah.
Okay. Well, we should be coming up to the end of the session soon.
Sure.
We'll take a couple more questions. One question from Benjamin David Taylor Robinson,
right,
on unit holders' participation in the acquisition funding.
Yeah.
I think the funding, we talk about renounceable rights issue, we talk about PERPs and private placement.
Right.
How can unit holders take part in the funding?
Yeah, I think it's a good question. I think we were going to do the preferential shares offerings, which then that will provide the opportunity for the unit holder to take part in the funding. Of course, it will be based on the number of units that you hold, and then we allocate that kind of certain number of shares you can subscribe based on the unit you hold. But of course, you can also subscribe for more if you want, and I encourage you to subscribe for more, because that is when you can actually have a higher pickup of the positive DPUs that we are talking about. If you subscribe for double, that means instead of the 10.5% you are talking about, it will be 21% kind of thing. So that is something that you can consider. But I think we will certainly put something in the market for our existing unit holder to participate, because we believe, and we really thank you for the support, and we want to give something back to the unit holders for supporting us. And this is a chance that you can actually take part in it, and you can actually get the kind of good pickup on the distribution as you participate.
Thanks, Kevin. If I can summarize it as part of our closing remarks, Kevin, we have a golden opportunity in the Western hub of Singapore.
Yes.
Once in a blue moon trophy asset.
Yes.
Great DPU accretion.
Yes.
A strong funding model.
Yes.
And in the pipeline, there is potentially PP.
Yes.
Potentially PLQ.
Yes.
So great story.
You know it all.
So how do you wrap all this up in a few words in terms of your strategy, Kelvin? As CEO, how can unit holders look towards you and be their leader? Where are you leading us?
I think it's a good question. And for those that know me, I have been in the REIT industry for easily rather since the beginning of the REIT industry started.
Since Keppel REIT.
Since actually since Ascenders
REITs,
REIT.
yeah.
So I've been always thinking that this REIT is a vehicle that provide that kind of pension-like kind of distribution to the unit holders. So I will tend to behave in a way and make sure that I can actually structure that so that the distribution will be pension-like, sustainable, and something that people can enjoy as they invest with us throughout the journeys. And as what I share with you, it's as good as you managing a house. I think you want to maximize if you own a house and you want to use it as an investment, you want to maximize the return of the house, at the same time how you can create more space for the house to have more renter. And as it mature enough, then how you can sort of like sell and then give a good values to the asset.
When you retire, when the kids grow up.
Yeah, so it's all that kind of thinking. So I want to actually make sure that the cash flow from the underlying asset continue to perform and produce that kind of stable and sustainable returns. So we believe GEM is one of the assets that it has that kind of potential for that. And also the office, I might not have actually thought too much about the office, but the office is actually fully leased to MND, and MND, Ministry of National Development, and certainly that gives the kind of strong cash flow and all other things. That I think I strongly believe in GEM. I don't want to take up too much of your time, but I think that is a good asset that I think is good for the REIT.
GEM is a real gem.
Yes, a real gem. Yeah, that's true.
And just one more word, Kelvin. If you want to use one word to describe this transaction, this acquisition, what's that one word you will use?
One word: excellent.
Excellent. So thank you. And with that, let's put our hands together. We can't hear you, but put your hands together to thank Kelvin Chow, our CEO from Lendlease REIT, for answering very, very good questions and very, very good answers for a golden opportunity with a trophy asset.
Yes.
Thank you very much, participants, and have a good evening.
Thank you, Mr. Low. Thank you, everyone. Bye-bye. Have a good evening.